All right, today's podcast, Sizing Your Trade, determining how many shares to take in each trade. Really looking to cover a couple of things today and want to help with understanding how you take the right size, right? Now, to be clear, taking the right size is something that is only part of a broader plan, but we'll talk about that a little bit later. So, first and foremost, let me say that anything I say here is not providing advice. Bear Bull Traders does not provide investment advisory advice or any type of advice at all. So it's only for training and education purposes only. All right? So what I'll cover today is I'll just cover some basics to hopefully ground us and put us in the same mindset. I'll talk about the different elements of trade sizing and then the core methods. Then we'll go into a little conversation maybe about should you trade partial sizes. So if you're picking a size, should you do half or quarter sizes or double your size for that matter? And then I'll flash on some of the BBT resources and tools, and we'll do a more general Q&A. All right, so that's our agenda for today. I will say that you need to, when you're looking at trade sizing, and let me get to that in a minute, actually. Let's start with some grounding and basics. Trading is inherently difficult, right? Stock trading brings out a lot of emotions, and it's a very tough skill to manage. It's one of those things where at its face it looks very simple, but it's actually complex in how you implement it. And if you go online and look up, day trading, I always love doing that and finding background about day trading. I'm always amazed about the articles you find, right? Statistically, it's been demonstrated that 90 to 95% of traders lose money and leave quickly from day trading. We also know that there's a lot of mixed emotion. People feel differently about how you should trade, right? Day trading, smart or stupid, was a great article I found. But we have to keep in mind that a lot of the failure rate comes from the fact that people do not approach trading with maturity. They don't put in the right tools, they don't put in the right processes and methodologies, and that's what we're looking to try and help today with just one element of that. So, putting aside all of the negativity out there, how do you increase your odds of success? When we know 90% fail, let's figure out how we get better. Well, the way you get better is making sure you have all of the elements you need to be successful. That would include having the right platform, having the tools you require for success, making sure you understand how to perform technical analysis on a stock, making sure that you understand the fundamental analysis principles and know when to pay attention and when to ignore it, having a strategy for your trading, and of course having a strong risk management plan. I would say those are all the base elements you need to have in place to be able to trade appropriately. But equally as important to those are your psychology. Are you in the right mindset and the right place to be able to trade effectively? And in fact, despite all of the weight that this provides, and this is where a lot of people focus, right? You focus on your platform and getting the right tools, and is my account set up, and which broker do I use, and studying technical charts. I would argue that if you weigh them, psychology is more than 80% of the battle. It is the lion's share of the effort that you need to put in. And while today we're going to talk about trade sizing, which is an element of your strategy and your risk management, one of the key reasons why you need to really pay attention to your trade sizing is because of psychology, not because of the technicals. Now they interrelate, of course, but if you take too big of a size or too small of a size, frankly, depending what you're trying to accomplish, they can radically affect your psychology and your ability to stick to your plan, stick to your strategy, and manage your risk appropriately. So at the end of the day, right, it's about what goes on between your ears. Manage that effectively, and all the rest will fall into place, is my honest view. So let's get to what we're talking about here in terms of trade sizing. First thing I want to do is put up a couple of terms that I will use, because everybody uses terms differently, and I know that when I use them there can be confusion. So I thought I would just ground us here. When I use a term, here's what I mean. So in terms of buying power, I mean the base size of your account, whether that's $10,000 or $20,000. Buying power in this presentation, we'll talk about that base amount, not leverage. So if you can leverage 3 times your account, so I've got 20,000 cash, they give me 3 times leverage, so I can trade $60,000. That's not what I'll be talking about. Buying power will refer just to the dollars you have put into your account. When I use the term risk, In this case, and for the the duration of this podcast, it will be about the risk you're willing to take on any individual trade, right? Not total risk in the markets, not risk against a stock. The risk that you're undertaking in a trade. How much of your account are you putting at risk on a percentage or a dollar basis? Stock technicals, hopefully fairly straightforward in terms of the technical analysis of a stock. When I say in play, in this case, I'll be referring to the amount of your buying power that's being used on an active trade. Okay, so for instance, if you buy 100 shares of a $100 stock, you have $10,000 in play. That doesn't mean that's your risk, right? Your risk is very different from how much you have in play. You may only be risking $20 or $100, but you could have 10,000 or 20,000 or 100,000 in play. And risk reward is, hopefully we all understand that. Basically, it's the relative return you're looking for on any given trade. So if I'm risking 100, I would want a $200 return. That would be a 2-time risk reward. Okay, so those are some terms that I use that when I was going through preparing this, I realized I might need to define. So how do you pick your share size? There are 5 main methods that people use, and I'll go through each one of these in detail. What I've found is I've ordered these in the order that I've found they, in terms of their popularity. Fixed size seems to be the most popular way for people to pick their share size, right? I will trade 100 shares. But it actually has one of the worst risk management profiles on its own. Now, keep in mind something I said a minute ago. I'm assuming when we're talking today about trade sizing, you're doing this within a risk management strategy that will have other elements to it, including what your stop loss is, the risk that you're taking, your strategy for entering a trade, the technicals you're observing, the signals you're going to use to get in and out. However, on its own, I would argue that fixed size is one of the least risk managed ways. Now, there's a way you can improve it, and we'll talk about it in a second. And there's a fixed risk method I'll talk about, which is the method that I use that I believe is probably your best inclusive approach. Now, that being said, I am biased. I won't hide from that. I'm absolutely biased because I've spent a couple of years figuring out the best methodology, and I believe that this is the one that gives you the best risk reward. However, there's difference of opinions out there. So keep in mind, everything I'm going to be telling you is from my point of view, and that there is difference of opinions. So let's talk about fixed size. So how does it work? Pretty straightforward, right? Trade a fixed number of shares on every trade. Whether that's 100 or 200 or 1,000, you're just going to pick a number of shares to trade. So what are the pros and cons? Well, it's easy, right? There's no calculations. If you're taking 100 shares, you know it's always 100 shares. It's easy for you to understand. It's easy for you to pick the size. Now, if you want to script it, now I'm not a scripter, I'll tell you that now. I like to do things manually because it forces me to consider the trade and the elements of the trade. But, we'll address that throughout this presentation about scripting it. If you want to script it, it's pretty easy, right? You just put the number of shares, it's sort of a fixed amount. You can go with that. On the con side, it does create a highly variable risk. Meaning, if you take 100 shares of a stock that moves $1 in a minute, it's very different than taking 100 shares of a stock that moves 10 cents in a minute. It's also, you have a different buying power, a different amount of money in play that you have to put down if you're buying a $20 stock versus a $300 stock. So keep that in mind. The other thing it doesn't do is inherent in just picking a fixed size. It doesn't consider the risk that you take. So what does that mean? That means that when I take 100 shares of stock A and I think I have to take a 20-cent risk on it, I'm essentially taking a $20 risk, right? 20 cents times 100 shares, $20 risk. So let's say that's even a successful trade and I make 2 to 1 and I made $40 on it. But then I go to take another trade, 100 shares is my flat rate, but this is Tesla or something that moves much more, and I figure I've got to take about $1 risk. So let's say you take $1 risk on that, you're now taking a $100 risk on that trade. To get 2 to 1, you have to make $200, but when you stop yourself out, you would lose $100, but you just lost twice as much, more than twice as much as you made on that first trade. So inherent to it, it doesn't consider that risk. Now there's ways you can mitigate that, right? Some of the risk management strategies, if you like using a fixed size, is only trade stocks with a similar dollar value. If you're always trading $20 stocks, then then your risk is going to be relatively proportionate, assuming the movement of the stock is relatively similar. The other thing you can do is that you can have within your strategy using full, half, and quarter size options. Now, I would argue that's sort of a kludge. You're taking this and now you're having to manually decide when you're going to take half or quarter size because the risk is too great or you're not as confident in the trade. I believe if you're following a strong technical strategy, you either take the trade or you don't. But again, open for debate. All right, so what you're going to see now is all my slides have the same setup. So let's go to the next one, percentage of account or your buying power. So this is basically you calculate the number of shares based on a fixed percentage of your account or your buying power. And I've given the same example all the time, always using a $30,000 account and roughly $100 stock. So in this case, let's say I was going to, in any trade, I'm going to put 50% of my buying power and I've got a $30,000 account, then I'm going to be buying 150 shares on $100 stock. Hopefully that math makes sense. So what are the pros and cons of that? Well, certainly you know what your buying power is on every trade. Some people, they need that comfort, right? I don't want to put too much of my money, sort of in the trade. This allows you to make sure you're managing that buying power all the time. It's also easily scripted, right? You can have that scripted where it basically looks at your account and your buying power and does the math. So instead of a fixed amount like this, it'll just take whatever your current buying power is. However, it still has the issues of highly variable risk. It doesn't inherently consider the risk that you're taking on the trade, right? So 150 shares of a $100 stock, is the stock moving $1 every minute? Like, where's your technical stop? Is it $1 or $1.50 below, or is it 12 cents? The other thing that I don't like about a percentage of account is that if you actually script this or use a strict percentage of account, it changes on every trade. So let's say I make a good trade and I make $200. My account is now $30,200. The next trade I take, the math changes because now I'm trading 30,200 in this calculation. Or if I lose money, I'm taking less on the next trade. So, still I would argue it has fairly poor risk management, but you can fix that problem I just mentioned by updating your script daily to fix the BP amount. So if you're scripting it, you could say, look, I'm just going to assume my account's at 30,000 or whatever a base number is. The third way is a fixed dollar. So fixed dollar means I'm always going to trade the same amount of buying power. So it is essentially takes the previous method I said and it just fixes the dollar amount, right? So you're not really basing it on your account size, but it has the effect of fixing an amount if you're taking like in the previous example, if that makes sense. But you could just say, look, I only want to trade $10,000 at any point in time. That's all I'm willing to put in the market, no matter what my account size is. Or 5,000, or whatever your number is, right? But it allows you to manage your buying power. Again, calculations are simple. It's a fairly easy method to understand. I've seen a number of people who use it because they can manage it and they feel comfortable. They know they're not overextending themselves into the market. Again, I would argue the risk is variable, right? It does not allow you to calculate how much risk you're taking. You're really just saying how much money you're putting in the market, not how much of that money you're risking on the trade. And once again, it doesn't consider the technical situation of the stock that you're investing in. So again, relatively poor risk management. Now, on fixed dollar, like we had earlier, right, on fixed share, you can mitigate some of that risk by having half and quarter sizes as part of your strategy, such that you can better manage it. Now the last two are ones that people tend to use after they've traded for a bit and they move into, I would say, risk managed share sizes. So percentage of your buying power risk. So what this basically says is you calculate the number of shares based on how much risk you're willing to take. So for example, in this case, you would say, I'm only willing to risk 0.5% of my buying power on any given account. On any given trade, right? So what I'm saying here is on a $30,000 account, if you're risking 0.5%, right? You're basically saying, I'm going to, I better get this math right, embarrassingly. 0, $150, right? So that should be it. You're willing to risk $150 on it. So, you know, if you're willing to risk that amount, then you can go and take the trade. So you can script this, right? It controls your risk. It allows you to be able to figure out how much risk you're taking, and it ensures, what I like about this type of approach is it helps ensure that your risk is managed across every trade. So what this doesn't consider is it doesn't consider the value of the stock you're taking. It just considers the risk you're taking against the stock. So for instance, if you've got a stock that's moving, you know, your risk based on technical analysis is 50 cents away, it doesn't really matter if that stock is a $20 stock or a $200 stock. So the amount of buying power you're going to put in is variable, but the risk you're taking on it is not, based on whatever technical risk you're saying you're willing to take, right? That's sort of the calculation. Say, I'm putting a fixed risk on every trade. This gives you slightly better risk management. And by the way, one thing I will highlight at this point is that risk management, I will never put anything into the good or the high level of risk management, because you can only get there when you incorporate your share size with the other elements of your strategy and your risk management plan. So just to be clear, none of what I'm presenting to you will ever get into good. Again, what happens if you actually use a strict calculation in your scripting to do buying power? That'll change on every single trade, because your actual buying power will change based on whether you win or lose. So again, you can sort of manage that a little bit by fixing your buying power amount. Now, your last but not least is your fixed risk. Now, this is what I use, so I said I'm biased against it, readily admit that. But your buying power risk says I am just going to pick a flat amount that I'm willing to risk on every trade. What that does is basically it fixes your risk. So as my example here, if you're going to take a $100 risk, and you know that therefore, so what you have to do is understand the risk you're going to take, right, the $100, and you have to have already done your risk reward analysis on the stock to say, I know that my technical stop is going to be 50 cents from my entry, for example. Then you can figure out how many shares you have to take. So in this example, 50-cent risk on $100 risk on the trade with the 50-cent risk per share in the trade, hopefully that makes sense, means you can take 200 shares. I use this because I know that my risk reward is going to be the same on every trade. It's the best method for controlling your risk. It can be scripted, or you can do it manually, although the calculations are more complex. And it's, you know, I've been doing it for a while with fixed amounts, so I can do it fairly quickly, but it was really confusing at first. The downside, of course, it does change the number of shares you're taking on almost every single trade, because while you're fixed the risk per trade, what's variable is the risk you're taking on the trade, because it might be 40 cents on one trade, 30 cents on the next, 25 on the one after that. You have to recalculate every time to figure out how many shares you're taking. And depending on how you exit, right, how you partial out, that may complicate your ability to partial out. It improves your risk management, and it incorporates the risk that you've got in it, but it's a little more complicated to use, and it's a little more difficult to script, although, you know, you can actually script that in DAS and other platforms. So those are the 5 ways that you know, you've identified, or that I've identified here for us to talk about. Now, you know, I said you can actually pick any one of these that you want. I'm just giving you my perspective about which is a better risk and which is a worse risk. And Michael, to your question, I actually do have an Excel file that's available for all BBT members that I will post a link a little bit later here in the chat room that you can access. And it does have that simple calculation for the fixed risk method. It's really simple once you put it into a spreadsheet, so that, yeah, you can use that at any point. So hopefully all of that made sense. Any questions against those 5 methods? Again, I didn't cover it in depth. You can go back and look at the, you know, the sort of the write-up of this, and I'll make the charts available as well later. No questions? That's good. So I'd raised the question earlier about, should you take a partial size? Now, I am of the opinion that you actually should not take partial sizes. But keep in mind, my perspective comes from using that fifth method I talked about. Because if I'm always trading $20 risk, I've already decided at the beginning of the day what my risk is per trade. So why would I modify that if I'm not so sure of the trade? I should either take the trade or not. It's either giving me the technical indicators that the trade is good to take, or you shouldn't. And this comes back to my personal philosophy and some that I've learned from Mark Douglas and others, where they say, you know, on any given trade, we do not know if it's going to be successful. So if it meets your criteria, you should take it at full size because that could be the one that's a big winner. And if it's not, you still have a controlled risk management process in place and you're not going to lose more than you expect. By taking half size, all you're really doing is cutting your probability of making a good profit in half. Admittedly, you're limiting your risk, but you've already decided to do that at the beginning of the day. However, I would point out to a couple of exceptions, right? So if you've hit goal, well, let's start with this one. So if you know you're entering choppy markets in an afternoon, so whether you've hit goal or not, you're saying, look, the markets are getting really choppy, I'm not sure what's happening, and it gives you comfort. So again, you would do it for psychological reasons, not for technical reasons. Then it might make sense to cut your size in half because it'll make you more confident to actually take the trade. Alternatively, if you've achieved goal on the day and you want to try some trades but reducing your risk so you don't put too much of that money that you've gained at risk, you could take a half or a partial size, right? Half or quarter or whatever. Or if you're testing new strategies. So let's say you've hit goal and at the end of the day, so I'd like to try a different entry methodology or a different scenario, then you might want to cut your size down and manage it. So Alex, you're asking a question. If you hold risk, trade constant, can't you just trade the same share size in every trade? No, absolutely. Well, in number 5, Alex, you wouldn't trade the same share size because the most important factor that you're trading against is how much risk you're taking per trade. And that's going to be dependent on what the technical indicators tell you, where they tell you the stop is. So if you look at it, right, and let's say you've got a moving average that you're trading against, and the moving average is only 5 cents below your entry, then you've got a 5-cent risk. If you decided your risk is, I don't know, $100 on the day, then you're taking a 5-cent risk. Well, you can take a lot of shares, right? You could take, what is that? That's like 2,000 shares, right? But if your next trade, you look at it and you're doing a $100 risk on the trade, but you've got a bunch of moving averages or the VWAP, but the VWAP is 20 cents below your entry, you can take a lot fewer shares because you're taking 4 times the risk on the trade, right? 5 to 20 cents. Hopefully that makes sense. So the other caveat I'll put in here is that if you're, and I talked about this earlier on the methods, if you're choosing to trade on a fixed share or a fixed dollar approach, then one of the only ways to manage your risk is to use partial sizing. So while I've said I don't believe you should use partial sizing, again, as I said, my perspective is from using that fixed risk, boy I have trouble saying that, fixed risk methodology. But if you're using a different methodology, then maybe you need to use the partial sizing. That's how you manage your risk. Again, I think it's sort of a kludge to the methodology, and you should consider maybe a more integrated way, but it's valid if that's what you want to do. Okay? So, that being said, I talked a little bit about how to script things. So you can script your number of shares based on a couple of methodologies, and there's some good posts. I picked this one from Kyle K29 that's in the Bear Bulls Trader forum about dynamically calculating shares. He gives some good scripts and some background. It's a great post that helps you understand how to do it and how the methodology works as he's posted it, and it'll give you a leg up. Now, the one thing I'll caution you to is that really consider what you're trying to accomplish by scripting things, because when you script and automate too much, you're distancing yourself from the logic process by which you're choosing the trade, and you're choosing how many shares to trade and the risk that you're undertaking. I'm perfectly fine with people scripting and when you want to do that, but I would suggest you do that after you're very comfortable with your trading and you know what you're doing. Some people script early on because they're not comfortable doing the calculations that quickly and they feel it misses opportunities. I am of the opinion that you shouldn't do it too early, because it's sort of like you need the practice figuring it out. And if it takes you long enough to figure it out that you miss the trade, maybe you shouldn't have been in that trade anyways, because it's moving faster than you can operate right now. And it's a real consideration when you're trading, because you will get faster, you'll get more efficient. We watch Andrew, here all the time, and he's so fast at this stuff that it's almost like he's intuitively doing it, or he's randomly doing it. But he's doing these calculations in the back of his head, and he doesn't have to sort of explicitly go and think about it. But when you're starting, you're nowhere near that fast. And I always use the analogy, I like to race cars on a track, and if you've ever tried to race cars or do anything that involves speed at those levels, when you first get onto a track, you can barely see anything, right? Because the inputs are coming so fast. You're moving so fast. I always tell the example, when I first went on a track, they put these cones and said, here's your braking apex, here's your turn apex, here's all the things that you need to worry about. I didn't see a single cone. Right? I just saw the corner coming, and I panicked, and I smashed the brakes, and I hit the gas, and I was all over the place. But after going around the track quite a number of times, it felt like everything was slowing down. It felt like, like I was moving slower, when actually I was driving faster around the track, and I was able to absorb more because I was getting used to it. My brain was used to the inputs, and I could manage more data and more information. The exact same thing happens in trading. When you start, there's just so many inputs and information you can't process it all. Give it time. That's why you need screen time in front of the screen that will give you sort of the time to get used to what's happening, such that you can figure out the trading. And I figure once you've done that, and you've figured out what methodology you want to use and how you incorporate it into your overall strategy, then go and script things, because you know how it works, you understand what it's done, and frankly, you will then better understand how to modify it when you hit those losing streaks and you're like, what's going wrong? If you just scripted it and you don't fully understand what you've scripted, it's tough to figure out if that's one of the things that maybe you're doing wrong. So again, all my perspectives, but hopefully that gives you a little bit of background, and gives you some food for thought. Any questions I can help answer? So yeah, Norm's saying experience in skydiving. There you go, exactly. I bet you it's the same. I've never done skydiving. My wife won't let me, but it's the same thing. You do something new, and you're like, how the heck do these people possibly do things at that speed? And it's a combination of experience and muscle memory, and it's just they put it together, and that's how you're able to accomplish these tasks. All right, anything you want me to go back to, or any questions? Everybody's focused on their trades this afternoon. Great. Well, thanks a lot then, everyone. Appreciate you taking the time. I said what we'll do is we will post, I'll post the charts as well as a video of a recap of this podcast, so you can get access to it in our forums. All right. Thanks a lot, everyone.